Welcome back to today's Daily Brief Explainer. Look, I am absolutely thrilled you're tuning in today because we are going to generate some serious heat. We're cutting straight through all that mainstream financial noise. If you've been, feeling that panic kind of creeping in from the latest doom and gloom news cycles, you're in the exact right spot. We're going to completely ignore the sensational headlines and just let the raw data tell us what's actually going on.
So here's our game plan for today. We're looking at 1. The earnings bubble myth, 2. Real math driving markets, 3. The monetary degradation factor, and finally, 4. Dynamics of the unthinkable.
All right, let's just jump right in.
Section 1. The earnings bubble myth. So right now, the major financial outlets, they're pumping out this absolute sauna of fear. Seriously, it's everywhere. They're working overtime trying to convince us that the S&P 500 is trapped in this massive, precarious, speculative bubble. But is it? Really? Look, we all know the media loves a good panic because, well, fear sells clicks, right? But the second you start peeling back that sensationalism, their whole argument, it literally just falls apart.
Just watch how they shift the goalposts. Recently, the media kind of pivoted away from screaming about a valuation bubble to now claiming it's an earnings bubble, saying corporate earnings are somehow artificially inflated. But actual market reality paints a totally different picture. The price-to-earnings ratio for the S&P 500 is sitting right at a very healthy 19. That is absolutely not a bubble reading. Honestly, considering second quarter results are heavily expected to beat estimates, the hard data actually hints the market might be undervalued right now. Crazy, right? Moving on to Section 2, Real Math Driving Markets.
Okay, so if it's not a bubble, what exactly is happening out there? To figure that out, we've got to step away from the headlines and step down into the comforting, solid reality of macroeconomic math. Let's break it down. The Fed estimates the U.S. economy is growing at 2.7%. Add in an inflation rate of 3.5%, and you get a total nominal economic growth rate of 6.2%. It's actually a pretty simple formula. Corporate earnings don't just exist in some mystical vacuum. It makes total mathematical sense that they're looking strong when the nominal economy is expanding at over 6%.
Now, take a look at this 4.5% figure. That right there is the current U.S. bond yield. And here is where it gets really interesting. When you stack up our 6.2% nominal growth against that 4.5% cost of borrowing, boom, it reveals this massive hidden monetary stimulus. The economy is literally expanding faster than the cost to borrow money. So mathematically, corporate earnings are perfectly positioned for really robust growth.
Which brings us to Section 3, the monetary degradation factor. If we really want to understand why the S&P 500 historically pulls in an average yield of around 10%, even with all those terrifying short-term corrections we see, we have to talk about monetary degradation. Essentially, this is just the continuous devaluation of your currency over time, usually driven by whatever political or economic policies are in play. Think of it this way. Market growth isn't always just about companies making better products. A huge chunk of it is simply a mathematical response to politicians constantly devaluing your money. Let's ground this dense macro stuff in reality for a second. Let's look at how the smart money actually prepares for the future. You might have seen this. Tech billionaire Michael Dell and his wife announced this massive fund that invests 10 grand per newborn in the US. The idea is that by the time these kids turn 17 or 20, they'll have a nice chunk of capital for college or starting a business. But here is the critical detail. It's not just about the charity, it's about exactly where that fund manager is parking the cash. They are dumping it straight into top-tier U.S. equities. Why? Because they know, for a fact, that monetary degradation is practically guaranteed. Holding cash or even standard fixed income over a 20-year horizon is just a losing battle against currency devaluation.
And this really drives the point home. When you compare that historical 10% return of the S&P 500 against the standard yield of public debt, like the returns you'd get by just dumping Social Security contributions into government bonds, the gap is just staggering. Smart funds always choose equities over standard debt because over a 2-decade timeline, equities are one of the only reliable vehicles out there to consistently outpace that monetary degradation we just talked about.
All right, let's wrap this up with Section 4, Dynamics of the Unthinkable. So, okay, we know the long-term math totally checks out. But what about those sudden, heart-stopping short-term drops that scare everyone half to death? Well, sports journalist Dante Panzeri actually coined this brilliant phrase, dynamics of the unthinkable. He was talking about football strategy, but honestly, it maps perfectly onto the stock market. It describes this recurring, almost mechanical pattern where markets will intentionally undergo these terrifying, unimaginable drops just to sweep out the weak, panicked, and exhausted investors. It's like a stress test. They push the market to the absolute limit, forcing the weak hands to sell in a panic, literally right before initiating the next massive rally.
Let's look at a live example of how this actually builds out using the KSPI index, which is heavily weighted in semiconductors. Back on May 20th, it took a sharp dive, hitting a low of 7,050. Then, just a few weeks later on June 11th, boom, another dip down to 7,400. If you apply the dynamics of the unthinkable framework here, the market is ruthlessly sweeping out everyone who panic bought or panic sold during those chaotic little windows. It's a purge. Once that exhaustion sweep completely finishes playing out and the weak hands are finally flushed out of the system, a solid floor is established, and the next upward leg deploys.
So, what does this all mean for us? Ultimately, it comes down to choosing your operational framework. When that next sudden, totally unthinkable drop hits the market, and trust me, it absolutely will, what's your move? Are you going to let the loud financial media dictate your fear and shake you completely out of your positions? Or are you going to rely on the real math, understand the mechanics behind the sweep, and actually use the data to your advantage? I'll leave you to meditate on that one. Thank you so much for joining me for this explainer today. Stay sharp out there, and I will catch you next time.